all, and welcome to the Sector Roundtable on Financial Inclusion. Financial inclusion, my dear friends, has been the most exciting space in Indian impact investing industry. In fact, most of the asset managers and asset owners in the impact investing space have been associated with the sector at one or other stages of investment. With the industry maturing, we now have a good contribution from the other sectors, but this sector still accounts for the highest assets under management. We have a stellar panel here today to discuss about the sector. But before we go into that, I'd like to take a minute to thank our session partners for this session. A big thank you to the Northern Arc team for helping us put this session together. In the interest of time, let me quickly introduce the panelists here. We have amongst us Aditya Bhandari, Partner and Co-Regional Director Asia in COFIN. We have Anurag Agarwal, Group CEO and Partner Avishkar Group. We have Arijit Dutt, DGM SIDBI, which is Small Industries Development Bank of India. Fred Kottakas, Regional Manager Asia Pacific Triple Jump. Jyotsna Krishnan, Managing Director of Edivar Equity. Ravi Vukadala, CEO Northern Arc Investments. Rekha Unnithan, MD and Co-Head of Impact Investing, Nuveen. Royston Briganza, CEO Grameen Capital. Pankaj Raina, MD Zephyr Management LLP. So I will now like to hand it over to Ravi Vukadala, who would be moderating this discussion for us. He'll set the context for the discussion with a presentation. So over to you, Ravi.
Sure. Thanks, Ranjana, and thanks to IIC for putting together this event and for assembling such a stellar panel. We are all raring to go to talk about one of our favorite topics, right? Financial inclusion. And the context was set up in the opening remarks by none other than Mr. Munjal as well, in terms of how do we democratize access, including to finance, to the entire country. So I'm just going to take about 10-15 minutes to give a brief on where we are with respect to financial inclusion, what some of the data and insights we've been able to see over the last decade that Northern Arc has operated in this sector, and then we'll dive right into the questions and put this panel out into answering them. So I'm just going to share my screen in case you don't see it. Okay, so I hope the screen is visible. Yeah. So this is going to be an India-specific discussion with respect to where we are on financial inclusion. And the first slide pretty much just tells on a relative basis that India is underpenetrated. This is something that we are well aware of, but the scale is truly large. If you look at the amount of credit to households, it's only about 11%. The savings rate is high at about 30%. That's largely because the state does not provide a lot of social security, and hence savings are just natural. But the square with the small dot in the center is where the action is. So only about 7% borrowed from a financial institution, which has now grown to about 10%. But this is largely because both savings as well as credit is informal in nature. And a large part of the country, whether it is individuals or corporates, have their earnings in the informal economy, which explains why they are not able to access the formal financial institutions. So microfinance, which has been one of the most, discussed sectors at this event, has been the one which has done a lot of good work and made a lot of inroads into financial inclusion. If you see the trajectory in growth, we're close to $50 billion of total AUM as per microfinance. And within that, just the NBFC MFIs have about 3.2 crore, which is about 32 million individual borrowers. So while they constitute only about 5% of overall retail credit, they still have about more than 30% of the number of borrowers that they touch. So this bite-sized credit has really worked. Plus it is 100% women, which is also a gender that is neglected by the other forms of asset financing. So if you look at the spread as well, about 75% is in rural, more than half is in agri and allied sector, and more than 40% is in the east and northeast sections of the country. all of which talks about how microfinance has been instrumental in terms of making forays into where the formal financial institutions such as the banking industry has not reached much headway to. But within the overall retail credit sector as well, right, there are a lot of gaps. The overall sector, especially on retail lending, is somewhere about 40 trillion INR. So, and out of this 40 lakh crores, about 60% is basis collateral. So if you see home loan, loan against property, that's where the initial lending has always been. Banks, NBFCs always want collateral when it comes to lending, and there is still a lot of room towards making more loans in auto, credit cards, consumer loans. These are still untapped sectors. And within these sectors as well, there are very few pan India players. So while it is cornered by the top five, but because of the regional disparities, there are a lot of small MFIs, small NBFCs, which operate in each of these segments, which have not been able to grow to the particular size. And this is something that we'll be looking at in this panel as well. If you look at the total gap, which is also a hindrance to the scale, for MSME itself, it's a $38 billion gap. Within vehicle finance as well, about $16 billion is still in the unorganized market, leading to money lenders, leading to other forms of financial institutions which may not be well regulated, being the primary source of lending for borrowers in this segment. These are livelihood finance. If you look at the cost of finance, this is also something that continues to remain inordinately high as compared to the rest of the world. So even banks and NBFCs charge somewhere about 10 to 18%, depending on the kind of borrowers they service. But the unaddressed market, this is between the 16 to 24%, where the majority of the borrowers lie. It is a pretty high cost of finance to pay even from formal institutions. And that's largely because of the feet on street kind of model that microfinance follows, as well as the difficulty of accessing these borrowers. So what we will also examine in the panel today is whether we can bring down this cost of finance and whether the new digital rails that a lot of these fintechs and other NBFCs are implementing can help bring down this cost of finance. So early signs are good. If you see the spurt in digital lending from being nowhere in 2012, as of 2019, it's about $110 billion. And there is a spurt of the number of fintechs that have come up in almost every niche that is, whether it is payments, whether it is lending, wealth, whether it is reg tech, and following. And there is ample reason for this as well, right? You look at the way India transacts across FY16 to FY18, cash, check, and ATM, which was what you can say the physical means of transfer of payments, has come down from 63% to 39%. So Indians are more comfortable transacting on mobile, transacting through internet, digital transactions are leading the way. And this is the ecosystem that can promise the holy grail, which is of low cost and easy access. And that's what a marketplace aims to provide as well. So the infrastructure is set. There is good growth, but we will also examine on whether this itself is enough to further the cause of financial inclusion. If you look at what the government has done, there is a lot of infrastructure that has been put in place, starting from identity to connectivity to intermediaries. So there is a trusted intermediary, which is a bank, which is the custodian of money. There is connectivity, which provides access to every subscriber there is. Today, there are more rural broadband subscribers than urban subscribers. The number of Jantan accounts are close to 40 crores, of which 55% is held by women. And there the unique identity has full saturation when you look at from a population perspective in terms of citizens enrolled in this program. And now with GST also coming up and more SMEs as well as corporates on the network, despite the glitches in the network, this provides a huge database of infrastructure which can be leveraged by the private sector. Additionally, there are some very innovative ideas that are coming together, such as account aggregators. The Bharat Broadband is ensuring that access is there for the entire country. The regulators are keeping pace with eKYC. NPCI is showcasing month-on-month increase in terms of transaction volumes via UPI. The government in itself is spearheading a lot of initiatives with DFIs such as SIDBI. In Startup India, there is infrastructure which leverages the India stack. So all of these pieces of the pie come together to provide the base on which the private sector can then leverage and deliver more financial inclusion. So the stage is set in terms of showcasing where we are today, what is the infrastructure that has happened over the last few years on the back of digital, and whether this can be leveraged to further the cause. Now, I'm going to also share some insights that Northern Arc has been able to put together based on our decade-long track record in terms of we work with about 200 financial institutions in working at small, bite-sized retail credit. We impacted more than 43 million lives. And in terms of size, while we are more than 500 districts, on a year-on-year basis, we are providing more than $2 billion across financial inclusion on a yearly basis. So if you see the India map, this is where a lot of the data has been leveraged from across the sectors of microfinance, fintech, affordable housing, agribusiness, and corporate finance. Now, based on these 200 odd institutions that we work with and the number of data points that we leverage, what are some of our learnings, or what do we see as the spread on what kind of impact has been made? So I'll start off with microfinance. So what we have done here is quite interesting. We've taken all the unique clients that microfinance has lent to across all of the institutions that we work with, and we've overlaid that with an index developed by CRISIL. So CRISIL has an Inclusix index, which talks about what is the level of access that a particular individual has in the country. And if you see on the right side, the eastern and northeast part of the country do not have much of an access. The southern parts of the country, whether it is with respect to bank accounts, whether it's with respect to access to finance, have been reasonably well penetrated. Now, if you look at the left side, this shows where microfinance has been prevalent. And this is the latest data as of March 2020, whereas the Inclusix index is more of 2016. It shows that microfinance has been quick to go to those sections and those geographies in India which had not been covered very well. So whether it is Bihar, whether it is Uttar Pradesh, Bengal, Northeast states such as Assam, there has been a proliferation of new borrowings, new clients that microfinance has enabled, largely towards furthering financial inclusion. Now, while microfinance is 100% towards women borrowers, we see a completely opposite trend in vehicle finance. Here, 99% of the commercial vehicle borrowers are women, are men, and 90% of the borrowers on the two-wheeler are also men. So the geographies are also almost, you can say, polar opposites, where a large part of the concentration is in Rajasthan, Maharashtra, and these are the industrial clusters as well. Hence, a large part of logistics takes place here. So whether it is last mile finance, last mile trucking finance, these states are the ones which have been on the forefront. Here, while a lot of the growth a lot of the outstanding portfolio is in these states, we see a large amount of potential in terms of over the last couple of years. More and more lending is happening across the new dedicated freight corridors that are coming up, whether it is from Delhi to Mumbai on the western side or on the eastern side. And with the container hubs being set up, we expect that a large part of the vehicle finance penetration will follow some of these infrastructure investments. But so far, a large part of the portfolio, as well as lending, is happening on the western side of the country. When you look at small business finance, here the trends actually follow the industrial clusters. So Tamil Nadu has one of the highest concentration of small and medium enterprises. That's where a large part of the lending is concentrated. The ticket sizes are also larger in industrialized states such as Maharashtra, Gujarat, West Bengal, and Telangana. West Bengal is seeing a large part of the increase in lending in small business, and that's largely also due to Bandhan Bank coming into that area. What is an intriguing proposition to see is the bottom bar graph. So if you look at the portfolio size of non-bank financial companies, the smaller non-bank financial companies, which have a portfolio of anywhere from 15 to 70 million, start out with about 30 to 40% portfolio in the NTC side. Now, NTC means new to credit. So these are the borrowers which have never had a loan earlier, and this is largely due to access. And as the book grows larger in size, this proportion is reducing, which means that it is the ones, the new NBFCs or the fintech NBFCs or the NBFCs which have identified need and are managing to find new clientele are the ones which are servicing this segment as compared to the larger NBFCs or the banking segment overall. Even for fintech, if you see, it largely follows where small business lending is. And this is because fintech, by its very nature, does not have any physical infrastructure. And hence, it tends to leverage on the collections infrastructure or the consumer records infrastructure that is already in place because of other players such as microfinance or small business lenders via through the NBFCs or through the banks. So the proliferation is largely in those states where infrastructure is existing and is available. Now, what are some of the key hindrances towards limited penetration? And some of the reasons cited in surveys, one is high operating cost, especially for bite-sized credit. And we've seen this happen in microfinance. Lack of collateral, because when you want to service somebody at the bottom of the pyramid, there is usually no clear land title, and without collateral, most of the banks and NBFCs will not lend. Unsecured lending is still a very niche segment. Credit cost has traditionally been high. The ability to assuage creditworthiness when you don't have a credit record, when you don't have collateral, and when you don't have effective access to data has been one of the hindrances as well. But something that we've noticed over this lockdown period is that the NTC borrowers have done much better than borrowers with the credit score of somewhere around 650. So it is not that the NTC customers have unable to pay or do not have the willingness to pay. It is largely that they were never afforded the product that they desired and hence could not access finance. It's not in their ability or willingness. Gender inequality is definitely there. Except for microfinance, the entire lending universe remains skewed towards women. And this could also be in part due to limited financial literacy, as we do not have universal coverage of women being educated in the country. And that is one of the hindrances as well. So this is where we stand. And this provides some good context for where we can start off some of the questions that are to follow on how do we address these inequalities, or how does the panel think that we'll be able to further the cause of financial inclusion. So I'm going to dive right into it. I'm going to ask Jyotsna first on, in your view, and basis on what's seen in the presentation, what is your view on how financial inclusion in India has gone up this far? And where do you see the outlook in terms of the new digital rails as well?
Thanks, Ravi, and for you're responsible for a thoughtful question. And I was thinking, looking at your slides, I think the few things that have gone really well, I think are there has been a lot of good quality commercial talent which has moved into the space of financial inclusion, which I think is a great sign for times to come. Because as we all know, execution is the key to how well we do. There is a lot of capital that has flowed, and I think partly coming from a place of having been investors in both India and Latin America in terms of having a view into multiple emerging markets, I think our regulatory framework has been conducive to the capital that has flowed in so far. And microfinance is a great asset class as an example. Now, I will say that when I look back and I think about, we've probably been part of 14 regulated entities right from day zero almost to scale and that have done well in the financial inclusion space. If you ask me, the one takeaway that I have is probably financial services and financial inclusion is not a sector in itself. And what I mean is, I think a lot of focus goes on lending and collections, but the crux of this sector is it is really something that cuts across all sectors as far as impact is concerned. And what one needs to understand is the underlying economic activity that the financial inclusion facilitates. And over time, I think the institutions that are beginning to do well, even as you go beyond microfinance, when you start looking at more specialized lending, when you look at the role of technology, I think the more the emphasis is on understanding the underlying economic activity at the end of the end borrower, the better the probabilities of success are. Because the reality is that most of financial inclusion, which is really a proxy for the formal financing, and you referred to it in some of your early slides, is a very small fraction of the reality of financial services in India. Most of that exists within supply chains, it exists in the informal markets, and this is a very small fraction. So I think that's a humbling statistic at some level, because as much as we think what we see about NBFCs and regulated entities is a reflection, that is just the tip of the iceberg. The bottom of the iceberg is the massive underlying financing that happens within businesses, supply chains in India, right? So to me, that's the part that we still need to figure out how to understand, wearing an institutional hat, and to tap into the wisdom of, to be able to integrate fully for the next decade or so, probably.
It's very interesting. I think we'll have to come back to how we will address this, given that maybe NBFCs are not able to address it so far, or how do we ensure that supply chain finance can be woven into the different ways or different products that NBFCs lend to. So I'm going to refer this to Anurag as well, because when you straddle microfinance, you straddle different forms of lending via Avishkar as it is present, as well as having a fintech platform, you have all the means of access, right, to some of the points that Jyotna mentioned. Can you use a microfinance loan? Can you use a fintech loan? Or can you use the platform to connect supply chain intermediaries to each other? So how has been your experience in terms of ensuring that we have the product fit, or we can further the cause of financial inclusion using these My Right product and platforms that current Avishkar controls?
Thanks, Ravi. So I think firstly, in terms of what has worked well is in microfinance we've seen this huge growth, right? I personally got involved in this space back in 2005, and the whole sector together was not even $100 million. Today, we are it was all about 500 crores of formal lending through the private sector microfinance institutions at that point of time. Today, in March 20, the reported number from MFIN is over 2 lakh crores. So, that's the kind of growth that the sector is seeing. And it's a combination of factors. It's a combination of regulation, the banks coming forward. I think ICICI Bank, SIDBI had a big role to play in terms of providing the initial financing when the risk models were not developed. Of course, the operational efficiency that has come in has also helped to bring down the overall cost, along with the regulatory framework that came in with Malegam, etc. So all of that has propelled this, and capital liquidity that has come in both in the form of equity and debt has helped professional talent moving into the space, has made it more robust, and then technology has come in to make it more efficient and affordable, and of course that is still work in progress. The same kind of depth and maturity is not being seen in the other sectors like MSME, in housing also very early days, I would say, in terms of penetration and work that has been done. So there, I believe is that in the MSME, like Jyotsna was mentioning, the bottom of the iceberg is a lot bigger than what we see. So the MSME opportunity is perhaps 10 times the size of the microfinance opportunity, but in terms of penetration is probably 1/10. So in terms of just the available opportunity is 100 times bigger than that. So that's the kind of opportunity that is in front of us. And as you yourself have mentioned in your presentation, that there are a lot of people who have started, working on that in a very serious manner and coming at it from different angles. Some very physical, some very digital. We ourselves have, put together our physical and digital efforts together in a single initiative called Ashv now. So I think leveraging both the physical aspects of it as well as technology for the outreach and for the efficiency is extremely important, even for credit evaluation. And as we get more and more data, so again, you're getting more and more data rich, and as you have access to more data, more, it's these are all heuristic models. As you sort of learn more about these clients, you get better at reaching out to them as well. So I'm very positive that this is only going to go up, and we are going to get more efficient at doing this, and hopefully with over a period of time we should also be able to bring down the cost for the end.
So here, what I also hear is that digital is more for the non-MFI space, and is that's probably something that will come as well when we talk about digital, on whether it is more towards MSME, or can microfinance also leverage the power of data as you do.
I think you can't really do away with digital in any form of financing in today's world. And with this whole disruption of COVID, the center meetings are not happening as before. I was just talking to some of our direct businesses as well as some of the portfolio companies. The attendance there is no longer 100%. You can't even go and physically meet the clients. So until unless you adopt to digital interface with the end clients in terms of your interaction, in terms of payments, in terms of how you're credit assessing these models, you're going to be obsolete. So I don't think that equally applies to microfinance as well.
Okay. So I'm going to swing to Arijit, given the role that SIDBI has played right from the very beginning. And while we have seen the growth in microfinance, how would you put that growth in perspective? And do you think that it has largely been a push kind of thing with regulatory push such as SIDBI's of the world or priority sector lending, or the sector has been able to grow on its own? And how do we replicate that in other sectors?
Yes, thank you. As you said, I mean, microfinance has been something which is very close to City's heart, and we've been engaged with the sector right from the beginning. We started with support in terms of grants, and then moved into what we call transformation loan, and then kind of equity kind of support, and at the same time providing debt, developing a risk framework, and to a large extent this got mainstream when several of them, 7 or 8 of them, finally got banking licenses for small finance banks, and that was preceded by Bandhan Bank also, becoming a universal bank. So that's when the sector got mainstream. Some of the so after that, next, we used to call it, zero up to 1 lakh, loans up to 1 lakh, and then there's another segment of 1 lakh to 10 lakh, also identified as the Mudra segment. We call the missing middle segment. So that is where, as Lutsna said and Aditya said, a lot of opportunity, but probably that is where we are trying to replicate the microfinance story. So we had a lot of hopes with, and we still are very hopeful of the small finance banks. We also engaged with them on similar lines when they were in the process of transforming from microfinance institutions into small finance banks, helping them with the, working with them the equity support as well as refinance support. So that is one institutional vehicle which I feel has a lot of potential for working successfully in this 0 to 10 lakh missing middle segment. We've also, they also spoke about the cost of credit being high. So we have a kind of experimental scheme which we are working with NBFCs as well as fintechs called Prayas. So there we have, we tried to work out a low-cost model where we are targeting those borrowers, especially women borrowers, who have graduated from the microfinance segment and they want to set up their own enterprise, maybe with 1 or 2, own employees, small businesses. So, so these are the segments that we have been working on. Is definitely one of the focus areas. The challenge remains is what kind of instrument would be appropriate for say doing something like supply chain financing, how to get informal lenders or from the purchasers and the suppliers together, maybe through fintech. So these are some of the challenges which we are looking at. We are working. This experience, especially our prayer scheme or our engagement with SFP has been encouraging. Uh, and of course, Mudra itself is a institution in that segment. So, this is definitely it's something which we are pursuing.
So the 1 to 3 lakh segment is something that deserves
Correct.
particular focus.
1 to 3 is for prayers, and 1 to 10 is the which we call missing middle segment, which which, I think Josna and Aditya both explained, and that we also try to map, what kind of lending happens in this segment, what kind of informal lending happens, what are the factors which encourage borrowers to stick, continue with that traditional or informal financing. So these are areas where we are working on.
That's interesting in terms of how do we graduate microfinance borrowers into these kind of larger ticket sizes, more tailored products.
Yes.
I think it would be useful to also bring a global perspective to this in terms of how do we see the whether it has grown similar in other countries, and so for both on their view on how India compares with the markets that they see outside and whether microfinance has evolved in a similar way. I'd like to ask both Freek and Rekha in that order in terms of what has been your experience seeing the India story in financial inclusion as compared to some of the other countries where you invest in as well.
Yeah, thank you, Ravi, for the question. And overall, I'm always very optimistic and positive about India. I think I can echo many of the earlier comments. What is going well in India is that you have indeed a very solid regulatory framework. And a good infrastructure in the country in terms of credit bureau with the Aadhaar card, with eKYC. I think those aspects, India is definitely one of the front runners compared to other markets that we work in. And having the credit bureau, and then also very strong regulation for microfinance institutions, where I do think there is a bit of and to some extent you can even say over-regulation, because I do think that looking at the restrictions that MFIs have, you see very little variation between MFIs. They are not allowed to take in deposits. You have 85% of your assets need to be in the joint liability group model. So that also limits the scope for that tailor-made financing and the graduation of clients. And it only takes a new institution really to set up, whether it's transforming into a small finance bank or setting up a separate NBFC, for these MFIs to really focus on tailor-made products. And I think allowing MFIs a little bit more flexibility will make that transition also easier, and also allow for clients to graduate more easily.
Rekha?
Thanks. Assuming you can hear me. Hi, everyone. Maybe a bit of context about our role in this market. So we're a global impact investor and invest both in the United States, Europe, as well as select emerging markets, with a focus on financial inclusion, education, healthcare, and also climate change mitigation. So we have a fairly broad remit. Just put that in context when you look at kind of my comments, because financial inclusion is very important and probably one of the most mature sectors that we have backed for some time in various formats. I think in the global context, the maturity of the Indian market is quite unparalleled, I will say, just the sheer size of the population, the maturity of microfinance as an industry, and the learnings that happened over the past decade or so within kind of pitfalls that have been then regulation coming to fix, and then so it's been a really interesting journey, being exposed to that sector overall in the global context. Also, we started our investment practice through investment in select funds that were either global in nature, that had exposure to India as a market, then transitioned to India-specific fund managers. And today, a lot of our focus is also on direct investment in the country. So that's been a very organic evolution for us. And India is one where that organic evolution happened first compared to other markets. So, and that is important to note because the scale, depth, and breadth of the Indian market is significant. Some of the other large markets where we are active in the same format are markets like Mexico, and we have some exposure in a market like Peru. And to the point of kind of regulation, you're seeing during times like COVID, where just government involvement, policy has such a deep impact on the sector, particularly financial inclusion overall. So we compare kind of like-sized businesses that we own, minority stakes in India versus Mexico. And because Mexico never quite acknowledged the COVID crisis, lending continued to happen. And companies that did it well have continued to grow through this time, as opposed to what India had to do, and I think appropriately so, instill a moratorium and really kind of put a pause on growth. But it's been interesting to kind of see that in parallel, what I call the tale of two cities, right, or two countries of equal kind of need and depth and maybe maturity, but very different outcomes. And so I think we're keenly watching what's going to happen the next 6 to 12 months as they come out of very different approaches to handling a crisis. Now, I'm particularly really fascinated by the SME and MSME finance space. We have exposure today through the Avishkar Group, through our fund investments, as well as through companies like Samunati and others. And it's fascinating to me to see how unscratched this whole market is and how many different business models exist. And to put in the context, microfinance seems almost cookie cutter, right? You have a JLJ approach, you have a certain cost of funds, you have an OPEX model, it's formulaic. And what's exciting about SME finance is it's not formulaic. So that leaves a lot of kind of questions to be answered, but also, in our view, means that multiple models may be needed, are needed, whether it's digital, physical, whether it's sector specific, whether it's sector agnostic, and that will vary by ticket size. And so we're kind of very optimistic that multiple business models might work in multiple contexts. And so that kind of is part of our investment strategy overall. We also look at this in the context of developed markets, right? Small business finance is not just an emerging market gap issue. It's an issue in the United States. It's an issue that commercial banks, alternative lenders are facing here. So, we look at the ecosystem in the US also as a context for kind of how we compare and contrast investments. But overall, of the $1 billion we've invested over the past decade in impact, close to 20% of that has been in India. So just to give you, no other country outside the US has that level of exposure for us. So, and financial inclusion being the largest of those exposures. I'm not sure I quite answered your question, but those are some perspectives to get us started here.
I think we're getting a clear view in terms of what has been echoed by many panelists in terms of microfinance being more of a mature sector, even though it's in a little bit of a straitjacket and doesn't give too much room for experimentation. And maybe the jury is still out on whether small finance banks can address the MSME aspect. But to your point that 20% in India means that it's too large a market. It has evolved and we've seen some good growth rates as well. So given the maturity and the size of the market, I think I would want to invite Royston's views, a veteran commentator on what the state of financial inclusion has been so far, and whether view on microfinance is as has been shared by the rest of the panel, and can it do MSME?
So I'll take the veteran part first, and clearly it's the gray hair. So and commentator because of my love for cricket. So let me then jump right in and address two quick things. One with the Grameen perspective, and the other, as the erstwhile chair of Sadhan. And really, I think the genesis of microfinance needs to be looked at. And Rekha talked about the tale of two cities, and really, it's the tale of two planets here. The microfinance model and the SME model are distinct, and I think woe to someone who tries to sort of force fit one on the other. And as head of SME with HSBC, you really understand the different nuances of SME lending as opposed to the collateral that comes from a group or peer pressure. Two things, therefore, are critical. So one is commonality between the two, access to debt. Microfinance, with due respect to all the equity investors on the panel, would never have reached the scale that it did in India if it wasn't able to access the type and scale of debt that happened, primarily because of priority sector lending. So the availability of debt is absolutely critical to leapfrog a sector, irrespective. And now that we've set up Grameen Impact, which is to look at getting debt to affordable education, to affordable health, to affordable to green energy, to sustainable ag solutions, we are seeing that challenge. I mean, we were completely a flop. We thought that for 10 years we've had to scale microfinance by providing access to capital. We'll do the same for the other impact sectors. Other than putting a flag, we were not able to do anything else. We need to therefore create pools of capital. We need to expand the definition of PSL. We need to be able to create very distinct access to capital for non-microfinance like we did for microfinance. Just saying that it's a continuum and now we've done the group model and we've done the $100 loans and we can gravitate upwards is not going to happen. So the whole policy, the whole product design, the whole risk paradigm analysis has to be dramatically different. The approach has to be different, but the end goal has to be access to debt. If we are able to unlock debt for the sector, for affordable education, for example, you will have probably the same scale that microfinance had. If you can unlock debt for agri and agri-tech, you will have the same scale. So what do we, in our collective wisdom, based on our learnings of microfinance, need to bring to bear, I think is the moot point for this panel. The second one is, how do we look at the genesis of the product? Microfinance was designed around a community need, a community coming together, financial literacy, bringing in the woman, and engaging at the customer level. Are we doing the same when we're looking at SME finance? Are we looking at the same model when we do affordable health finance or agri finance? And so we cannot just be fascinated purely by technology for the sake of technology. It's a huge enabler. It's more pronounced now than ever before. We are in a crisis today which combines the Andhra crisis with the demonetization crisis. The Andhra crisis says you can't have collections. Because of social distancing, you can't have collections. Demonetization said you can't have money. Today, anyway, there is no money. So the combination of those two is what is hitting the sector now. From 98.5% recovery rates historically, we came down to 77% in March. We came down to 8% in April. That's the scale of the impact. And the tale of two cities has to play out. But maybe there's a twist in the tale, somewhere. But that's the type of sort of body blow we have given ourselves to keep the body alive. And therefore, how do we recreate? How do we build back better? I think those are areas of focus. So bringing access to debt and looking at what is the genesis of the product. So when we look at SME finance, are we really keen to look at creating those ecosystems like Jyotsna talked about with the supply chain, like Rekha talked about in terms of, building those ecosystems around each of these subsectors, like was done in microfinance. It took 30 years for Professor Yunus to build Grameen to where it is. There is an ecosystem, there is a group methodology, there is a whole process around it. and are we able to use technology to benefit those process and ecosystem development? So I'll stop there, but the access to debt I think is absolutely critical. How do we bring more debt in, irrespective of the subsectors, and how do we really create a product-based, custom-centric design where you are measuring impact and creating what we at Grameen call a capital with a conscience ecosystem?
Sure. So I think this is a very pertinent question in terms of the intersection of is debt available for these niche kind of products, and will it? It's not preordained that will follow the microfinance model. So both Pankaj and Aditya, you have backed companies which have products which serves a similar segment that microfinance does, but may not be only restricted to microfinance. You've done education, finance, etc. So how has been the access to debt, as Royston pointed out, and does it follow a similar model as for microfinance? How easy has it been to design a product for somebody at the bottom of the pyramid who could not be served by microfinance? So I'm going to ask Aditya first, and then Pankaj. So Aditya, I can't hear you. I still can't hear you. I'm not sure if the others can.
Can you hear me now?
Yeah, this is much better.
I'm sorry about that. Okay. So I think it is a very useful point, and that's a classic debate, right? And so there's a lot of talk around equity investments in India, but actually what takes the sector forward and gives you the depth and the reach is actually the debt investments. So equity takes the first step to give the conviction to various lenders to come on board. So I think in our experience, financial services companies have, thanks to SIDBI, local lenders, various DFIs, private lenders, there's a strong traction that we see with every rupee of equity that we infuse. There are people around who are getting more and more confident to provide debt. But the challenge really comes when we go beyond microfinance and start looking at other sectors. Of late, there's been a lot of action around non-microfinance centric financial inclusion companies, be it education, MSME. But the moment you are an NBFC, there is a broad-based set of investors. But the problem is when you go to SMEs, which are non-financial services company, I mean, that's where you have a bit of a concern that the market is very small, and I think that the opportunity is fairly large. So I think India as a market has done great. I mean, you would see that 2005 to 10 was the evolution of microfinance. From 11 to 15, the new breed of entrepreneurs came in, they challenged the status quo, started doing something beyond microfinance. And the time has now come that, equity investors have followed the trajectory, but debt investors for non-microfinance sector has been a slightly on the lower side. And for that space, be it agri-tech or healthcare or education, all those SMEs, there is a huge appetite, and for the economy to grow, which is inevitable given the vast unmet demand, you need to have debt solutions. Without that, I think equity will be there, but it will lose steam. So it has to go hand in hand.
Am I audible?
Yeah, go ahead, Pankaj.
All right. So, okay. So thanks, Ravi, for the question. So firstly, I mean, I'd like to start by stating a fact that microfinance in India has proven that there are many resilient business models that could emerge and allow these customers to and aspire to take loans to become micro entrepreneurs. And like you pointed out, we have a vehicle finance company and we have an education finance company. And these are microfinance borrowers who graduated and who now have an aspiration to send their children to school. And hence, there's a requirement for that product in the market. So microfinance in general has proven to be resilient. And Royston very specifically pointed out the two crises that the industry has gone through. Most of us on this panel have been observing the sector for more than a decade now. Kolar, AP, Demon, and now COVID. And I think we should be able to come out of it, and microfinance will again prove that the business model is resilient and these customers are willing to come back because they need debt, because aspirationally they want to grow and scale. Now, debt and equity in some sense goes hand in hand. There are entrepreneurs who are trying to create new models, and they're creating new models and designing new products such as used commercial vehicle loans, education loans, or supply chain finance products. And investors need to have the risk taking ability to back these entrepreneurs. What we have noticed is most of these new age businesses are able to attract good quality talent, and this talent comes from several institutions, microfinance, banks, and other larger NBFCs. And these managers have a basic idea around what kind of product and what kind of service is scalable, and they come out with a basic operating model. From a banking perspective, we've observed banks asking us this question: how do these borrowers scale up, or how do these businesses scale up? Now, without equity and debt, these businesses would not be able to scale up. But we've seen certain new age lending institutions come up, such as yours, such as Caspian and others in the market, who are able to provide the first or the second check, which allows these new business entrepreneurs to prove their business model to scale. Additionally, while debt is important, we've also seen multilaterals provide guarantees, and these are new structures that are emerging. And these guarantees are provided to mainstream banks to lend to several of these new emerging models: microfinance, vehicle finance, education finance, micro entrepreneur finance, MSME finance. From a new product perspective, while customers graduate, it is very important to understand the product design, because product design is vastly underrated in India, because most businesses have struggled to understand the customer psyche and have been struggling to design products. So understanding of local ecosystems, which was again pointed out earlier, and understanding of customers and understanding of how they graduate to become a micro entrepreneur and designing products is often the key to build scalable models, which could be backed by debt providers. And while we do talk digital, I think the human touch point remains critical for now, because we need to educate these borrowers that there are products and services available, and these enterprises are willing to work with them to help them improve their livelihoods, to give them a chance to grow bigger. And without equity, without debt, without the support of these new age entrepreneurs who are trying to design new products, it would be very difficult to build scalable models.
Very true. Thanks, Pankaj. So I think a clear kind of view is emerging that on the one hand, microfinance familiarity breeds comfort. So it will continue to grow, it will continue to geographically move. It's an established business and model, good access to both equity and debt. Whereas the need, as mentioned by multiple panel members, is for a little more on the MSME, SME, individual loan segment, which requires tailor-made products. So there are multiple problems here. We've already highlighted that access to debt is a problem. Tailoring a product, while the company can tailor it, maybe it is not very well understood by the ecosystem who can then provide debt to it. Right? So I'm going to ask Aditya if fintech is the answer to some of this. Does fintech enable better acquisition or better product design or customized product design? Or is there something else that is also needed?
So I think there's a lot of, well, how do we define a fintech, right? But I think we are a very rural focused impact investor, spends several years in the rural markets. And what we see is in the rural market, people's ability to use a Facebook or maybe read some news, that's their level of, with due respect, technology advancement. The moment we tell them, like, look, can we do a Paytm or a wallet transfer or a UPI? Yes, they're learning, but the curve is very slow. So effectively, what we have done at Incofin is we have backed teams, entrepreneurs who are very tech savvy, who can build a physical infrastructure with a strong tech at play. So some of our companies based deep in rural areas, and they run on SAP and the highest category of servers that they manage in deep rural areas. But the level of technology that they use is at their level. Customers could walk in who prefer a physical touch point, get to the product or the service, but it's the team of our portfolio company which helps them resolve it. In short, what I'm trying to say is it's in India, especially if you're trying to cater to the rural market, which is, let's say, bottom 40 to 60% of the market, you need a physical touch point. It is very fancy to go and talk about having fintechs. So to us, technology is an enabler in the business. It is not a business model. We don't find excitement in saying that we're going to back a tech company. I mean, that's not who we are. I'm not saying that that's not the right approach. For us, a company should have a balance. If you're catering to the bottom 60, you need to have a strong physical touch point with a super exceptional team who understands technology and challenge the status quo, cut the flap, help the customer as much as possible. But at the end of the day, that customer base that we are targeting, they need a physical interaction. So that's been our experience. So tech is very important. All our investments have a very high tech focus, but it's not, I mean, it's just that there's no physical touch points either on sourcing or on collections. Everything's on the platform, and that's something that we are a bit, or maybe we are yet to learn that.
So what you're saying is that for tech, I mean, there's obviously fintech for acquisition, there's fintech for credit decisioning, which you already said that it's a problem because there isn't that kind of data available, and fintech for collections, which you're saying it doesn't work too well. So given that this is still largely going to be, a feet on street and a physical touchpoint model, how do you enable scale? Is there something that a player like Sidbi can come in terms of patient capital, in terms of incentivizing at lower price, or how do we enable that entities which want to design these new products, which still require a high operating cost, get access to debt or access to equity? Is there more of a role for DFIs apart from some of the NBFCs like Northern Arc, which may not be that many in this ecosystem? So Arijit, if you would like to tackle that in terms of how Sidbi can participate in terms of enabling scale for entities like these.
As I mentioned, Sidbi, so also we are still working with the fintech sector, and we another sector where we feel has a lot of do a lot in this area of financial inclusion. So we designed some debt products, and we are operating a specific scheme for the fintech companies. That is just to address the query that I mean, as everybody emphasized, the debt is enabling debt or unlocking debt is one of the main unlocking debt is one of the main enablers for growth of these kind of institutions or any new format institution. So we started with designing a scheme for term loans on lines of NBFCs, specifically targeted towards fintech, which had parameters which could help us assist fintechs. I mean, NBFCs normal where regular NBFCs keep parameters where many fintechs may not qualify. So that was one of the things. Secondly, I also mentioned initially about this Prayas scheme uh, where we have tried to absorb financing cost part of it, so that the ultimate cost to the ultimate borrower is substantially reduced. And this is operated also through fintechs as well as some MFIs and NBFCs, including some SHG-driven MFIs also. So these are the two ways where we try to address the need for debt for the fintech companies as well as your the cost to the end borrower, keeping that cost low. With regard to equity, yes, I mean, because I could be wrong, but many of the fintechs have already attracted quality capital. They're all, several of them are well capitalized as well. So we don't right now have a product like that, but it's in, essentially because we thought that that is the main requirement. Whereas these companies were all quite well capitalized and those had very good talent as well. So that and addressing the issue of cost of finance so that the overall cost is in control. These were the two areas we acted upon. So first fintech segment is concerned. We're continuing to work. We have a separate vertical on that.
So Jyotsna, as having more than a decade's experience investing in both traditional and fintech companies, would you say that access to debt is not an issue, or some of these problems to scale are not really relevant to the portfolio companies that you work with?
Oh, there's no question about these questions because I think as far as debt is concerned, I mean, I know there's a lot of conversation on lowering borrowing costs, but if anybody was to stand outside the pawn shops in India through COVID, you'll know the value of liquidity transmission that is far more than I think the cost of borrowing for the end customer. The reality is there is risk aversion and a perception of risk with respect to underserved markets, and that's the biggest impediment to any liquidity transmission to this space, right? And just to give you a simple example, as far as technology and to Royston's point on product design, I think technology and all have done well as far as process efficiencies are concerned, bringing down cost of operations, acquisition, all of that. And similarly on product design, microfinance at some level caught on to a low-hanging fruit as far as the product was concerned, because to Rekha's point also, it is a cookie cutter model. What we're really missing is investment in understanding the underlying economic activity of the customer or the borrower, right? And I'm yet to see technology make a breakthrough as far as spitting out customer insights are concerned in a meaningful manner, which will help reduce the perception of risk. Even today, when we talk about tech playing a role in credit risk underwriting, we're talking a lot of it is about digitizing information or reading information digitally. It's still not telling our entrepreneurs what they will not find out if they were to walk the streets and talk to the customer, right? And the day we make that breakthrough, I think technology really unleashes the potential of furthering inclusion as far as our country is concerned. Because the beauty is, there is a lot of method to the madness in the informal systems. I mean, simple examples like how the power loom, handloom sectors work in Tamil Nadu. There are proper systems of master weavers maintaining records. There is a proper system that exists. It's just not digitized. And I think we are still some time away for those investments to be made to actually help reduce the risk perception, and that's what goes into the cost of credit perception. That's what is the barrier to liquidity transmission. And to be honest, a lot of private equity capital will follow if they see data, but you need early stage risk capital to back entrepreneurs and talent to go and change the perception of what's it going to take to trust this customer segment. And that's the understanding you need, right? So technology, product, all of that will start becoming more powerful if it can uncover the underlying economic activity and visibility into that.
So do you see this as an impediment to scale then, in terms of if the cost cannot be lowered?
No, so the cost of borrowing itself, I think, is one factor. But like I said, it's the risk perception. Even if you were to continue with current borrowing costs for NBFCs, etc., to me, the opening of the taps to let more liquidity flow is a far bigger driver, and that needs to happen a lot more. I mean, honestly, most of the products in the market price in the risk, right, or the perceived risk. And I think every institution in the market has demonstrated you all have maximum visibility that your non-banking finance companies have not really struggled with pricing and risk, right? It's not the end borrower who's living up to this reputation of high risk. It's really the perception of risk. And so the moment those taps get opened up, honestly, we can absorb a little bit of cost of debt if you can move the liquidity to the end customer, because scale takes care of a lot of the efficiencies.
Yeah.
And with data, you can bring down the cost of borrowing as well.
It's very important what you mentioned in terms of risk perception, and especially we haven't mentioned COVID even once so far, but given that we are right in the midst of the pandemic and mentioning it every day, the risk perception would be at a heightened level. So let's get.
And you had a great data point on new to credit customers not performing as badly as people would have thought they did, right? So
This
that's
has
the
been a
important
litmus
point to note.
test.
Yeah.
COVID has been a good litmus test for figuring out that the NTC segment is deserving, but risk perception somehow tends to overlook a lot of this data, which is also showcased. So let us take a couple of LP views on risk perception post-COVID into this segment. So Rekha, how are you looking at this segment, especially after what we've seen through COVID in terms of performance? And do you see any marked change in the way businesses will handle this?
Yeah. So I'll say that I did mention COVID early on, so it was mentioned, but because it's top of mind for us, right? I think because I sit in New York and many of my team members are here, we are looking at kind of the world from a different lens. One being kind of the largest hotspot after Wuhan, post immediate COVID, just living it, but two, just recognizing that the perceptions of risk on the ground versus those far away are quite different, right? The information gap is huge. Anurag can be testament to this with some of our conversations in May and June, but there is it's overlaid by this idea that macroeconomic policy and government intervention has been so different, right? So, growth was paused, let's be clear, in India during the lockdown and during the moratorium. And so when I look at two opportunities in a market like the US versus Mexico versus India, one is growing, one is paused, and one is a TBD, it naturally begs the question when will things open up? What will things look like when they open up? I'm happy to say that I was largely kind of surprised, and I'm first to admit when I'm wrong, that the collection efficiency far surpassed my initial views of what would happen. Right, like I am a bit more of a pessimist, maybe part of my institutional upbringing here at a large organization, but my sense was that when moratorium officially ends, and or when government borrowers have the ability to pay, I wasn't sure that they would pay, right? That they would prioritize these loans, and to see collection efficiencies at high 80s and 90s in some of our companies is just really, really, really great. And we've also seen kind of the difference between the ability for investors to back companies during this time. We were in a fortunate position that our exposures to companies had liquidity, were not cash strapped from a standpoint of immediate need. But now we're seeing transactions taking place, being priced, and kind of it also mitigates some of our views of risk because now multiple markets are opening up. I think there's still a question about risk with respect to resurgence. Let's not kid ourselves that the music has stopped on COVID. We're seeing rates increasing globally in pockets. We do not have line of sight to a vaccine. I know different governments will say different things, but I think we need to still brace ourselves for potentially a second resurgence and potentially future lockdowns. But I think what's been learned already in India and other markets is the approach in managing that crisis. It can be implemented swiftly again. You could potentially still mitigate this risk largely. So we're encouraged by that. But the pessimist in me, still remains a bit to kind of see how things will turn out in 12 months from now.
So it is a little bit of a wait and watch kind of a situation. Craig, how are you seeing your portfolio companies, and is there any additional funding, financing help that you're looking at for the portfolio companies to weather this, the output from the pandemic?
Yes, I can certainly relate to the comments that Rekha was mentioning, that the collection rates have indeed surpassed the expectation. Also, when we compare it with in the global context, right? If we compare it to other markets, And I think India has been quite badly hit, but even so, collection rates have been quite encouraging. And overall, of course, any crisis, and especially such a global crisis, will increase uncertainty, will lead to higher risk perception, and also a more cautious approach from us as an investor, also even from our investors. So yes, it does impact, but I have not really been extremely worried about our Indian portfolio. And I think what has also, and again, this COVID crisis has showed, is that and that I think I'm quite positive, and what India has done extremely well, it has learned from past crises. So even if you look at what happened during demonetization, providing liquidity to the sector and the market was key, and I think that was what happened quite successfully. Because also, again, when we compare India to other markets, whether it's Indonesia, whether it's Cambodia, whether it's Myanmar, we have seen other markets where we work where our portfolio companies have requested extension or pause on repayments. And in India, we have seen that to a much lesser extent. So I think that again proves how the sector has responded, and how India has learned also from previous crises. And I think in the short run, liquidity needs have been to a large extent served. And I think that will be the secondary effect where you see portfolio qualities, the visibility on the actual portfolio quality is still to be seen, especially during moratoriums. All of those loans are not taking into portfolio quality indicators just yet. And we'll see that profitability will be greatly suppressed in this financial year, obviously. And I think that is something that we as Triple Jump are looking at, is providing support, and especially not necessarily the liquidity itself, but more on the capital side, where we see, okay, the profitability will be low, or some losses might even be there, that capital adequacy and solvency will become under pressure. And especially during a crisis, raising equity will be even more challenging and takes a lot of time, that we try to bridge that gap with, for example, sub-debt facilities to at least boost the solvency and provide some cushion there.
I think that's a very important point, given that the pandemic is going to impair balance sheets. And hence, what is the role of capital, both equity and debt, at this time, especially impact capital? I mean, we have
and especially providing that step in the middle, because everyone knows raising equity can take forever, and especially during a crisis, I think it's even more difficult. So having a product that can quickly serve those needs, I think would be beneficial to the market. So that is something that we are indeed looking at.
So should the equity providers also put in equity? Given that this is the kind of event that necessitates a show of confidence, and also to enable that the companies can continue to not have one eye behind looking over their shoulder saying that, okay, will I survive, and look forward and continue to extend liquidity to its borrowers. So Anurag, is there anything that Avishkar is doing in terms of supporting its in portfolio companies, especially at this time? And is this the role of impact investments right now?
So absolutely. So our perspective on this is that every crisis is also an opportunity. So we made some of our best performing investments during the Andhra crisis period, right? We backed people. So in terms of if you look at it from an equity investor point of view, valuations have certainly corrected. They are no longer at the same levels as they were, and rightly so, because of the higher risk perception. Growth is certainly compromised, like Rekha was saying. I think we've clearly lost at least a year of growth during this period. I think through the moratorium period, the first primary issue really was, around liquidity and survival itself, right? When the moratorium got announced and, you were not able to collect money from your borrowers, Many of the institutions had a hard time getting a similar back-to-back moratorium from the banks. But I think that's where the government stepped in a big way, and all the measures announced by the government, the partial guarantee schemes, etc., have actually helped in pump a lot of liquidity. And it's not been uniform, so I think the larger, better governed ones were able to access a lot more liquidity. The smaller ones, for the smaller ones, it was still a struggle. But to a large extent, the first immediate problem of liquidity got addressed to a very large extent. It is not like no equity investments happened in this period. Transactions did happen, maybe on convertible basis. People wanted to see how this will play out, so maybe straight equity structures didn't happen. Maybe valuations were depressed. Maybe there were excessive asks in terms of returns on that capital that was coming in at this period of time. But certainly these also create good opportunities for equity investors to get outsized returns in these kind of environments. The second level of issue is really, which is now happening, is once the moratorium is opened up, now you are really seeing what is the actual capacity to pay. So while the numbers have been encouraging on collection rates upwards of 18, even exceeding 90% and all, but our sense is that overall the delinquency levels in microfinance in SME will probably be 10x of what they would normally be. And when I say 10x, there will be a surge immediately. So as soon as September numbers start coming in, you will see it reflected in the PAR 0 numbers to begin with, and then as October numbers come in, you will start seeing it in the PAR 30 numbers, and by December you'll start seeing it in PAR 90 numbers. I think the overall rectification of that will be spread over 2 financial year, FY 21 and 22. So it will actually take us 2 years to actually figure out what is the actual loss. Past experience suggests that you're able to recover roughly 40-50% of what goes into these delinquent buckets, and the remaining is a write-off. So that's the kind of, so maybe the level of write-offs would be say 5x of what it used to be normally. But the good thing is that capital has been there, both equity and debt, and to a large extent that at least the wise ones, and that's the approach that we've taken with our own companies as well as portfolio companies, to make sure they're adequately capitalized instead of optimizing on things like valuation, etc. It's better to make sure that the company is adequately capitalized to go over this hump. So you will take some short-term hits, but every crisis is also an opportunity. So I think this is a great time to look at M&A opportunities. I would think it's good to position yourself as a buyer today rather than a seller. So
That's quite. We're hoping that the actual write-offs are lower than that, and
I would so yes,
especially with the moratorium providing some breathing room. So estimates are lower, and hopefully
I just, Ravi, I just need to make an announcement for the audience. Our next two sessions are going to be parallel. So the parallel one in Audi 2 will start on time at 6:45. So this is just for the information of the audience. Yes, we will go in this session for 15 more minutes. We'll close by 7 o'clock.
Sure. Thanks, Ranjana.
Sure.
So I'm going to segue into an audience question, which is on the other extreme. While we're talking about some equity coming in to support companies, there is an audience question on saying that these startups, the lending startups, provide a valuable diversification to banks and NBFCs. So I'm going to put the question to the GPs on the panel on why we're not seeing any strategic exits yet. Is IPO the only exit? I know that's probably not at the top of my mind right now, but is there a case for a strategic exit for some of the investments that you made, given how they complement to where a bank or an NBFC currently operates? So Pankaj, if you can take that first, and I would invite views from the other GPs on the panel on whether a strategic exit on any of these startups makes sense.
Okay, so firstly, I think if banks are interested in slightly larger models which have scaled, established profitability, and ideally what we've observed is banks would ideally want to buy into businesses where those consumers could eventually graduate and become a customer of the bank. Having said so, there are various types of new age financing NBFCs that exist in the country. right? So commercial vehicle finance, education finance, MSME finance. As and when these models mature, scale up, I think acquisition by banks or acquisition by larger NBFCs, which would get classified as a strategic exit, is definitely an option for investors who've invested into these companies. I think more recently, SKS, which was rebranded, was acquired by a bank, right? And there'll be many such opportunities that would get created, and strategic exits are an option, are available on the table. What I've also seen is we've observed it across a few of our NBFCs. There is interest from banks to participate early in some of the transactions that we evaluate or study or have already invested in, because they'd like to understand how our businesses operate. We want some exposure to our clients with an intent to consolidate that position later. So while there have not been many, because the sector has grown so much, because the sector has attracted so much of equity capital, and we have seen a few NBFCs scale up, raise Series D, E, F, and several of them get listed. We haven't seen as many M&As, but there are M&A transactions that do take place, and M&A or strategic exit is also a viable option from an exit perspective.
Aditya, any quick comment on that?
Yeah, I think it's for me acquisition. You need the acquirer to be very strong. So in this market, what we see is the larger players are very strong. They've raised a lot of equity, and they have a visibility to raise a lot of equity. And there are smaller ones who are struggling and unfortunately are not able to raise equity. It's not only microfinance; it's across sectors, even in SMEs or other NBFC sectors. So the only issue that we see today is valuation. People are still hung up on a certain pricing that they feel is appropriate as a pre-COVID period, and rightly so that they also see the primary markets to make an opinion. But unfortunately, there is a gap. So there are certainly acquisition opportunities at our portfolio level. We are looking at a couple of opportunities. One side we are selling out, other side we are buying. So I think there are opportunities as long as people can come to the right terms in terms of strategic value and relative valuation. I think there are a lot of deals around, so you just need to be realistic.
I mean, especially makes sense from a large organization perspective to add this kind of capability. We have a lot more questions as well. There are two, three which talk about from a diversification perspective. Will a lot of these NBFCs start diversifying their product lines? So will microfinance move into other uh, product areas? Will say an education finance company will education finance be a vertical for somebody like a Samunati or with affordable housing as well? So Royston, given that you already mentioned that you are into multiple products and you started up a new vertical, do you think that this is the norm, that now more NBFCs will look to de-risk their product suite and have a common mode towards evaluating these same borrowers?
I think what will happen is the focus on pricing. I think that is something that while we're assessing risk, we're trying to go with the traditional ways of pricing that risk, using our sort of old commercial banking and other hacks. What we're not seeing is that we have a benefit, as Anurag talked about, opportunity and the challenge of being in an impact sector. There is a government who is desperate to bring the country back on track. There are global impact investors and philanthropists that are interested in supporting the 500 billion people, 500 million people that have dropped below the poverty line because of COVID. So half a billion have fallen below the poverty line just because of the last 6 months. There are CSR companies which are interested in trying to fix areas within their sort of focus areas of value. So, for example, Nestle is looking at food security, or Unilever is looking at women's empowerment. So each of these, is there a way to build a hybrid blended finance model that can actually create a better risk return paradigm than just saying just diversify because we know a model. Let's just try and replicate that across different sectors. I think that is the traditional way of looking at it. But I'm saying let's not lose sight of the fact that we are in an impact sector and in an impact conference. And let's not just be talking banking and financial services and risk return from that paradigm, which is why we need to break those silos. The RBI PSR definition has a list of activities which are different from the 2% CSR list of activities, which are different from the SEBI SPCF list of activities. Is there a way to again create a horizontal pipe for money to flow there? We have tried and pioneered globally SDG impact bonds, saying in a single unit, and we've done 6 of these, but below the radar because they're all tiny. We want to do micro bonds as opposed to the $100 million impact bonds that are being announced. We want to do 100 bonds of 1 million each. So we've done in goal 5 for women's empowerment for 2,000 tribal women in rural Madhya Pradesh. We've done one for goal 8 on livelihoods and skilling for 20,000 jobs for skilling and afford livelihoods companies. We've done one for clean energy on number of tons of carbon reduction. We've done one for a COVID impact bond last month on using women's artisans to make masks and sanitizers. So, and therefore getting the end beneficiary. So the corporate to say, I will pick up the tab for the coupon if you are able to meet this outcome. So the risk return paradigm has many, many allies. We need to look beyond the traditional financial services world because they're not a traditional financial services player. Then we should not be in an impact conference. We are losing the opportunity, and I know we need to be sounding cool and commercially viable to attract mainstream and Wall Street and others. But at the same time, the value microfinance taught us is if we do what we do well, then Wall Street will come to us. We will do the $20 million Sequoia round. We will do the $100 million fund that come in from Rekha. It will come because we do what we know well and we do it well. And therefore, Anurag, we are happy. We are not going to fight about valuation. We're looking at raising $10 million only. So talk to us. But the fact is that we need to be able to de-risk creatively. I think that's the point I want to make, Ravi. The de-risking need not come by creating new product lines. The de-risking can also come by looking at different risk return paradigms to de-risk, looking at others who are incentivizing the same outcome. The government is interested in women's empowerment, sanitation. Let's bring them on board to pick up the cost or to de-risk. Someone else is interested in food security, let's bring them in. Someone else is interested in reduction of carbon, let's bring them in to de-risk. So the need to be creative, the need to be thought leaders, I think is something that is a challenge that's open to us.
That's very important, and probably I think the de-risking will also help to attract the capital that we need for scale. So we are almost out of time. I just want to get in a very quick question, and this is about addressing the scale that we need for financial inclusion. So quickly, from everybody in the panel, I just want 1 or 2 lines in terms of when do you see a telecom moment in financial services of universal saturation in India, and how far are we from it? So Royston, why don't we just start off with you?
Sorry, just repeat that. Universal saturation of financial inclusion.
Yes, so maybe too many words. When do we see a telecom moment?
When poverty goes into the museum. That's what Professor Yunus has always said. To show
so not happening poverty, anytime soon as per you?
Not happening in the way it should be, because financial inclusion without social inclusion doesn't help. So we need to bring in financial literacy, technology, and the whole gamut alongside, not happening soon.
So commercial plus impact. Rekha? Can't hear you.
You're mute.
Yeah.
Can you hear me now?
Yes.
Yeah. I think the COVID crisis is going to put hundreds of millions of people back into poverty. And I think we're going to be taking, unfortunately, a step back, not because there isn't an appetite to support that, but just the sheer impact of this crisis. So I think there's a lot more ground to cover, and I hope that we can at least make back time lost over the next several years. For me, what's really exciting is what businesses have learned during COVID about how to do things differently. And I'm not talking about everybody being on Zoom all day. I hope that will change and we go back to meeting in person. But about how to serve clients in a deeper way and get insights in a deeper way, and really move that forward in a in-person world, right? Because there's no other proxy for learning by fire, and that's what all companies and investors are doing today. And so we're just kind of and driving that inclusion story even more as a result of those learnings.
So we need to move faster to get to where we were earlier. Anurag, quick comment.
So yeah, I think one can't argue from the fact that there is a very significant impact from COVID. It has pushed people back. There will be pain in the short term, but the fundamentals are still there, right? I mean, 1 year of lost time is nothing in comparison to the long journey that we've already been on and what we all intend to work on. So I think this 1 year of lost time is also time for you to reconfigure yourself, right? Become more efficient, figure out different ways to reaching out to people who were otherwise not. It also sort of the adversity brings out innovation as well, right? So I think a lot of work has actually been happening. I can vouch for that internally within our own teams, and also what we are seeing with some of our portfolio companies. So you are forced to sort of reconfigure yourself, and I'm quite optimistic that the opportunity set still remains, and I think universal access is a dream, but I think we will certainly get to a level where everybody will be able to we will be able to democratize this to a large extent, and we should be able to do this in a more efficient manner and with more choices to the end customer.
So I think we are just about run out of time. So any quick comment from the rest on financial inclusion and universal access?
I think we may not be achieved quite a lot in the last few years, so I would recognize that. And starting with a lot of work done by the government and Reserve Bank with the financial inclusion report, new kinds of institutions which have been licensed and set up, created. So I would be sanguine about that this is going to continue, and lot of we still are progressing very well on the technology side. So I'm quite positive on this. Of course, I can't give a timeline, but yes, we have done quite well, I would say, and it's recognized globally as well in the last few years.
Now we hope the pace continues and accelerates. So on that positive note, I want to thank each and every one of the panelists. I barely got through half of the questions, so thank you for keeping it so highly engaging, and I hope everybody learned from the panel as much as I did as well. So thank you, everyone.
Thanks,
Thanks, everyone.
Thanks, Ravi.
Thank you. Bye.
This was an amazing discussion. Thanks a lot, lovely panelists. Availability of debt is absolutely essential to leapfrog the impact sector. That's what we heard. And Royston, I think, has set the context for the next panel, which is the debt roundtable. So all of you in the Audi one, we are releasing our much awaited ISC Bridgespan report on debt financing in our next session, giving credit where it's due. So I hand it over to our CEO Ramraj Pai for this. Thank you very much, all the panelists. Thanks, Ravi.